Welcome to the Corporate Treasury 101 podcast. This is the second section of our conversation with Laurent Geunens about the technicalities of PoBo CoBo. PoBo CoBo are the acronyms standing for payments on behalf of and collections on behalf of. Laurent was a manager in the Treasury Practice of a Big Four consulting firm and is now the Global Treasury Leader at Punch Powertrain. Needless to say that he is a seasoned treasury professional with a tremendous amount of knowledge, in particular when it comes to in-house banks, treasury systems, and PoBo CoBo. In the episode of today, expect to learn the nitty-gritty details of PoBo CoBo. What are the restrictions treasurers need to bear in mind when it comes to PoBo CoBo, especially in terms of regulation and tax restrictions? What are the quantitative benefits of having such a structure in place? What the role of fintechs will be in the world of in-house banks and PoBo CoBo, and much, much more. If you enjoyed the episode, please consider leaving us a review on your favorite podcast app. This is the best way to support us. It is completely free, takes only 2 seconds, and makes Hussam and I very happy indeed. Last note before diving into our fascinating conversation with Laurent, we are now on LinkedIn. If you would like to reach out, suggest a topic, ask a question, or simply say hi, we will be happy to have you. Just look for Corporate Treasury 101. That will be us. With all that being said, please welcome Laurent Geunens. Maybe now entering in technicalities of it. PoBo CoBo be set up regionally, or should it be or can it be worldwide? How does it work exactly in terms of region you can cover?
It depends a bit on the structure of the corporate. It can be worldwide, but it can also be regionally. And it really depends a bit on how is the globalization of the company, how many countries are you located in, what are the local restrictions. It isn't possible in every country to set up an in-house bank or to perform PoBo CoBo. It's also not always allowed, like in some countries, tax payments and salary payments, they must come from a bank account located in that country. So giving an answer to the fact whether you have to do it at a regional level or a worldwide level, it's a bit nuanced, let's say, and it really depends case to case. And that's why there are, of course, a lot of consultants helping on this and working on this, so that whenever you have a question about this, that they can always guide you in the right direction, taking into account the localization of the company and also, of course, the tax requirements and so on.
Okay. That's interesting point. Why, do you know why would certain countries say, look, if you want to execute salary payments and tax payments, it needs to leave from a bank account located in our country? What would be the rationale behind this?
Yeah, it's actually a good question. I would need to...
No, perfect. It was just out of curiosity, because why would they? Probably to keep the cash within the country. That could be a reason.
Yeah, indeed. In China, it's mainly the reason indeed to keep cash in the country. Okay. They have a very strict, let's say, currency policy, and for them, it's they don't like to give away control. So they don't like when money is flowing out and in of the country, and they want to know what is happening. There are, of course, for in-house banks, which again, not really PoBo CoBo, but there are cross-border solutions, but that's always a bit more technical and complex. But mostly it's indeed that there's a tax reason behind it, a currency control behind it. You see, it really depends a bit, and you always have to thoroughly investigate why something can be done or if it cannot be done. It can also be that you have, let's say, a tax treaty or with the government, you have an agreement on something, and that's why for you it becomes, more beneficial to be in country A instead of country B.
Okay, that's super interesting. Okay, so we could imagine that restriction would be more or less linked at least to the countries where the currency is also restricted. So to name a few, you had China in mind. I'm thinking about quite some countries in Latin and South America. Those are economies where currencies are restricted, and therefore those types of practices will be less easy to set up or even impossible.
Yeah, okay, correct.
And that's the perfect transition then. In terms of locations, is there any that are preferred by corporates to set up the in-house bank? Where, of course, here focusing on PoBo CoBo, also interested into the in-house bank aspect, but first where do you want to put your PoBo CoBo center exactly, if it's regional or worldwide?
Again, here it depends a bit on where is your, let's say, your company located. First of all, you'll always take a location where you have a company. If, let's say, you have subsidiaries or you have your entities in Belgium, the Netherlands, the UK, you'll probably not set it up in Germany unless there would be a significant tax benefit or a reason why you would do it. So it depends. And then secondly, you look mostly at where is my treasury team located. A lot of the time, your treasury team is located in a location already for a specific reason. Okay. So it makes sense to check there. Is it worthwhile to keep your treasury center there and to also set up your, let's say, your in-house bank or to start doing your PoBo CoBos there?
Makes a lot of sense. I guess that would be linked to tax and regulations, right? You want to have treasury centers where operations are execute. Potentially you centralize certain cash. So that's where you would like to focus your treasury centers.
Yeah, correct. And also, if your in-house bank, for example, would make a profit or a loss, you want to see, of course, do I pay taxes on that? Yes or no? And where is it most beneficial?
That's a super interesting point. Does an in-house bank, because I guess the in-house bank is, its main function is to support the business, right? So how would it make benefits exactly?
When an in-house bank, it depends. You have an in-house bank, which can have several functions. It can be just purely an in-house bank that is supporting cash pooling, PoBo CoBo, but it's not taking on any FX risk, any interest rate risk. So you push it down basically to your subsidiaries, but you can also make it bigger. And then, you're coming in a situation where you're saying like, okay, the in-house bank will be taking over the exposure from the subsidiaries. And they're mostly, the in-house bank will get paid for that. So they will get a small margin, or the interest on your in-house bank position might be increasing a little bit. So depending on the function of your in-house bank, it could be that there's a different interest rate. And with that interest rate, it could be that your in-house bank is, let's say, earning a bit of cash.
Okay, that's amazing. Even if you are at arm's length, as we said earlier, actually that will be the reason. Because you're at arm's length, you're also meant to make benefits when you lend money to one of the subsidiary, and you will collect the interest.
Yes.
Super interesting. Is there such a thing as management fees for an in-house bank, or is it not something common?
Well, I have not seen it a lot. Mostly it's embedded in, let's say, the premium that is asked on the in-house bank position.
Okay.
But I would imagine that it could be indeed that there's a management fee on top of that.
That's super interesting. Okay, so treasurers can actually make money within the company. Are there any substantial cost savings when it comes to PoBo CoBo? You mentioned that you could save on the bank accounts that you don't need to open for certain subsidiaries. What are the more overview of the quantitative aspects and benefits from having a PoBo CoBo structure?
Yeah, the main benefit, of course, will lie, as we discussed at the beginning already, in the fact that you have there's a need for a lot less bank accounts, and you can do a lot of cost saving because you have less accounts. You could do your FX hedging, let's say, at an in-house bank level. So Euro subsidiaries with US dollar payments, they can all be made by the in-house bank, and then they can make sure in the market that they're fully hedged against the exposure, for example. So it means that you can get better pricing on your FX transactions. You don't need, if we talk about 6 subsidiaries, you don't need 6 US dollar accounts. Or with a Euro account, you can just go to your bank and say, I need to make a dollar payment, but then the spread on that will be very high. Mm-hmm. So it's mainly, that are the main cost savings that you can have thinking about PoBo CoBo. Okay. And just think about it, doing less transactions, you can close a bank account, you don't have to make your fixed trades. If you're a large multinational, this amount can start adding up very quickly.
That links to the fact that you need to probably reach a certain size, right, before it becomes interesting. It's because you are centralizing everything that you do not have to open multiple bank accounts and so on. Should company reach a certain size before the PoBo CoBo structure becomes interesting and or profitable in case they will make a little bit of profit? But let's maybe just focus on what are the requirements in terms of size in the first place to set up a PoBo CoBo structure.
If you want, you can do it actually at any size. Even a very small entity could do it, but then there will probably be a lot of manual work behind it. Mm-hmm. But you could indeed set up a structure even with let's say, 10 entities. But it makes more sense once you can start leveraging the systems in the background.
Yeah.
So once you can start using a payment factory, a TMS, a large scale ERP system, because that is the point in time that you can start working on a centralized team that is managing all those transactions. And that's when you can start leveraging technology, because the technology investment is not always that cheap. It costs a lot of money. So then it becomes interesting to say, okay, I want to put PoBo CoBo in place with the automation behind it, especially because if done right, there's a lot of scalability afterwards. If you do a lot of M&A or if you open a lot of new subsidiaries and it's implemented in the right way, it's almost plug and play basically, which saves you a lot of money, and it gives also a lot of, let's say, time savings within all the different teams.
Okay. You touched upon a very interesting point here, which is the team involved, because so we mostly think about treasury team, obviously, but when it comes to payments and even collections, that might be a different team, right? Within the organization, there is definitely an account payable team, probably an account receivables team when there is such a need. So what kind of teams are typically involved and or helps on the PoBo CoBo setup and maintenance?
Yeah, absolutely. You're right. So it's not like the treasury team is going to, let's say, book the invoice and then going to pay it. So that's not how it works. If you look at the P2P cycle, an invoice is coming in from a vendor, then the AP team is taking the invoice and it's making checks. Say it's starting with, do I have everything I need? Do I have a VAT number on the invoice? Is it to the right company? Is there a PO number, a purchase order linked to it? Was it needed? Yes or no? They will make all those checks. They will then book the invoice internally in their system, probably put it out for approval. And then once approved, it will be the AP team mostly that will initiate the real execution of the payments. So they will say, okay, these are the payments I need to do for this entity. And then depending on how your system is set up, it could go to a, a payment factory or to an ERP system that is then sometimes, if you want to do PoBo, even automatically recognizing like, but wait, for this entity, I don't have a bank account in this currency, so please pay from another bank account. But the initiation stage there mostly is done indeed by an accounts payable team.
Okay, super clear. That makes me think of, so we talked about netting on the podcast with Craig Chapman, and we were looking at intercompany netting mostly. Yeah, I can't stop myself from thinking there must be something linked here. I guess PoBo CoBo will only be for external payments then, or do you include a netting cycle in that?
No, mostly it's really for external payments. Okay. As you mentioned, if you have intercompany payments, that will mostly happen via indeed a netting module, or it just happens over the current account without netting, but just lots of cashless settlements. You can settle in cash. You could say, I need to pay them 1 million euros, but instead of moving the cash and having to pay for a transaction, you can just say we will settle it cashless and we will put it on the current account position.
Okay. The current account that we mentioned before, that keeps position and like a record of what happened between each entity. So there is at least a record somewhere of who owes what and in which quantity. Okay. Without entering into too many details, because I think we touched upon it, but what are the common tax and legal implications of PoBo CoBo? You named it. There are some countries where it's simply impossible, but will there be some countries where it's possible but absolutely not profitable from a tax perspective? I'm thinking like cash centralization might be an example of that, right? In Latin America, for instance, you can actually concentrate cash and have cash pool structures, but then you will pay a small fee for every sweep, so every fund transfer you will do, so it makes it non-profitable and therefore not operable. What are the implications in regards to this for PoBo CoBo?
It's mostly, as you mentioned, it's mostly tax related. So sometimes tax payments have to be made locally. Or there's an example like Japan, where it's very complicated due to legal tax restrictions to implement the PoBo. Okay. So there you really have to see like, okay, what are we going to achieve? What is my business case behind the implementation of PoBo in Japan? And is it worthwhile doing it? Similarly, in China, if you want to... in China itself, you can put up a cash pool, that's no problem. But if you want to repatriate the money to, let's say, the US or a different continent, it becomes a lot more complex. There are a lot of rules behind it. Okay. You can do a cross-border cash pool in there. I'm not even talking about PoBo CoBo here, but just about getting cash in and out of the country. So there are, with free trade zones, there are some solutions, but there are strict rules behind it, which you need to take into account. So every time you want to implement a PoBo CoBo or a cash pool, especially in Asia and in Latam, indeed, it's very important to make your business case and to check, is it worthwhile, yes or no? In Europe and the US, you see it as a consultant probably a lot as well. The market there is relatively flexible. PoBo CoBo, it's getting more and more accepted and done, especially by the larger corporates, because there is a real benefit behind it. But if you go to Latam and Asia, you really need to make your business case to see, okay, what is the benefit of implementing PoBo CoBo for my entities that are located in Asia and Latam?
Makes a lot of sense. And so if we detach ourselves from the third parties that are the governments that will, impose those regulation and tax, obviously, I'm wondering if there is any implications from a third party standpoint. When I want to collect money from the corporate that has a PoBo CoBo structure in place. I will expect probably a payment from a bank account in my own country, where the one I operate in, but then a payment from one of the treasury centers that is set up completely offshore or abroad. How does it work there? Is there any concern or things to keep in mind as a third party?
Mostly what you do when you have, let's say, a new relationship with a new client, you exchange information between each other already upfront. This is more, let's say, more what accounting is doing in your ERP system as well. But you set up in the master data of all your different systems, which can be in ERP, it can be in TMS, and so on and so on. You set up the client, and at that point in time, if you need to pay them money, they will ask you, okay, what is the bank account that you will use, and where will the money come from? Okay. And that way, they know basically when they set up in their systems, they will set up you as a client. They know, okay, they gave us this account information, because most of the time as well, they will ask for an account detail signed by the bank. So basically, can you give the evidence that the bank account is in name of the entity? And at that point in time, you'll have to say like, okay, but my entity is called ABC, but the bank account I will use will be DEF. So at that point in time, you will already disclose that you will be using a different bank account.
Okay. And from your experience, that's not something that triggers, that maybe that's not the correct word, but like puzzles the clients. Are like, okay, but what is happening here? Because I mean, anti-money laundering and like frauds combat whatsoever is quite a concern for a lot of corporates in those days. So does that not raise questions when like, okay, you're going to pay me from DEF whilst I'm dealing with ABC? Or is that completely seamless once you've done the due diligence and you explained the whole process from your experience?
Yep, it should be relatively seamless at that point in time. Of course, if you start using bank accounts like from Cuba or Iran, it's a bit of a different story. But even the bank you will be executing the payment through, they will already say like, okay, what's going on here? But normally in, let's say in Europe and in the US, this, it's not a real big issue.
Okay. Super clear. You mentioned it for Japan. In regards to what's key is the setup, like how to probably install the PoBo CoBo structure. How does that even work in the first place? Because you mentioned TMS that is linked to the ERP. You usually need a payment factory, which for our audience, the term we sometimes use on the podcast is the payment hub. So it's an additional software to the TMS that makes the link between the Treasury department and the banks. Usually it's one of the tools that is in the bank connectivity. But so how do you set up all this? If you say, okay, I'm a big corporate, now it's definitely worthwhile. I've made my business case. And we need PoBo CoBo to achieve significant savings and also operational efficiencies and so on. How do you technically do that?
There are real complex ways to do it, but maybe to simplify it a little bit. Yeah. Mostly you have in your payment hub, as you call it, you have some sort of trigger or a rule that is recognizing that you're doing a PoBo. So it's, first of all, you have your technical system that you're building. And whenever your business case is made, you will need to identify saying, okay, for these entities, I will apply these rules so that the system knows automatically it has to use a different bank account for a payment, for example. And I'm sure that there are people listening, implementing payment hubs and payment factories that can give a lot more detail about it. But mainly it's based upon rules where you say like, okay, this entity needs to make a payment. And based on the rule, it will identify if their own bank account will be used or if another bank account has to be used.
Can it be that you set up a rule for an entity, but you set it up only for certain payments. You say, okay, we're going to execute PoBo, so payment on behalf of from the header for this entity, not for all the payments. Or once you set up the rule, it's for all payments, regardless of what goes out. Or how does it work? Yeah.
No, you're right. You could say mostly different types of payments are being recognized as well in the system. And so you can indicate whether it's an urgent payment, a non-urgent payment. If it's in the UK, for example, a BACS payment, there are a lot of different types of payments and you can identify them. Like payroll is also clearly identified. Tax is mostly identified. Urgent payments are identified. So based on that, you could build a rule that is saying, if it's this type of payments, then indeed execute via a PoBo. But if it's a salary payment for, let's say, tax and legal reasons, I need my own bank account, then just use the own bank account.
Okay, sorry. And so what are the next steps when you want to, so once you've set up the rule, what are the next steps in order to set up properly the PoBo CoBo structure?
Yeah, in the next steps, first of all, you will need some sort of in-house bank account or some sort of setup to be able to keep track of the PoBo CoBo positions between the corporate and the subsidiary you're making the payments for or you're receiving the payments for. So we can go very technical here, how it's done in specific TMS systems, but mostly it's just, again, in the system, a rule that is recognizing the PoBo even from the bank statement, for example, which is immediately saying, based on those rules, like, okay, I know that this payment is done for entity ABC, put it on the current account of ABC. And then behind that current account, there will be probably an accounting setup, which is saying, make entry debit 123, credit 456, so that it can be interfaced towards a ERP system. And of course, in an in-house bank, the setup goes a bit further because you can have interest settlements. So you can do monthly, quarterly. What is the interest? Is it Euribor plus a margin? Is it something else? All that kind of stuff can, of course, be completely customized and set up exactly to the purpose of the corporates.
You would have potentially interest payments. What if, can this current account, based on the PoBo CoBo structure, so I know about transforming a current account into long-term loan, because it's been so long that within the cash pool structure, one entity was borrowing more than it was lending, so it turns into a long-term loan. Can this happen also the PoBo CoBo structure, or do you just settle the current account automatically?
No, it also, again, depends here on how the setup is done. Okay. The PoBo CoBo will create the intercompany positions, but if indeed at a given point in time, and that's again a tax discussion that you need to have, you're seeing that your subsidiary is having a borrowing position of over X amount for X amount of time, you could decide to convert that current account position indeed into a more long-term position. And that's an important difference where you pay interest on your in-house bank, but there's a difference between the short-term that you would do, the short-term borrowing, or when you would really have a long-term structural borrowing position towards the in-house bank entity. In that case, there are different arm's length principles because different benchmarks should be used. And in that case, you have to use a different interest rate. And for that, it should be normally in your treasury policies around the in-house bank, including the PoBo CoBo structure. There should be a policy to review these positions on a regular basis.
Absolutely. Could you have also, integrated in all this, the cash pool and the cash centralization structure? Because one entity keeps on paying on behalf of the other, but do not collect, for instance. So we just have PoBo, not CoBo. Well, one company will be short of cash at some point in time, right? So, but that will be not so much the case anymore if the collections of this entity also goes to the header, because I guess it will be the same entity, right? That you set up, the same entity would execute the payment on behalf of the subsidiaries and would also be the cash centralizator of a cash pool structure. Or am I completely misunderstanding here?
No, that's right. You could indeed say that you're making all your payments out of that central bank account, but also the collections for that same subsidiary could arrive on it doesn't have to be the exact same account, but it could arrive on an account held by the in-house bank. But it doesn't matter if you're paying from account A and receiving on account B, both in the hands of the in-house bank header. You can put it on the same current account if you want. So paying 100, receiving 80 would give you a position of 20.
I have a bit of a stupid question, but so let's say you set up PoBo CoBo. You set up a cash centralization structure in a country where you have very little tax or legal implications around this. As a subsidiary that is involved in both those processes, those three processes, PoBo CoBo, cash centralization, do you even still need a bank account then? Because you have everything sorted out for you at the central level. Can it be?
Well, mostly every legal entity requires a bank account in its own country just to be able to basically set up the entity. So I see the idea where you're going, and yeah, technically speaking, if you look at it, it could be that you barely use the bank account, but there will always be a bank account linked to each legal entity.
I tried to go to the extra mile in terms of quantitative savings and optimization, but it seems that I'm restrained by the tax and legal regulations. But fair. Okay, moving back to the setup. So we quickly touched upon the different software and technology that is required behind a PoBo CoBo structure. But so maybe just to summarize, you will need obviously TMS, so a treasury management system that would enable you to set up the in-house bank in the first place, right? The PoBo CoBo structure is part of the in-house bank. Mm-hmm. You need the ERP where you will have all the accounting entries, which means you want to have a proper recording of all the accounting statements and what is happening accounting-wise for the the header and the subsidiaries participating into a PoBo CoBo structure. And last but not least, you have the payment factory, so the payment hub to actually send the payments, right? And actually in payments, in files, batch payments, because you can centralize this as well. Is my summary correct so far?
Yep, that's correct.
Awesome. Anything else you need to, I don't know, can you have like additional third-party systems or vendors that could, enhance the whole structure, or that could circumvent the need of a TMS or a payment factory for smaller structures? I don't know. Is there such a thing?
Yes. Yeah, you don't have to do it in-house. You can also do it. Certain banks offer as well PoBo CoBo solutions with virtual accounts where they are in your name actually keeping track of all the positions and making sure all the payments are executed in the correct way.
Awesome. Okay, so I know of BMG who does the netting process, for instance, but you have also banks that could do a PoBo CoBo structure. Okay.
You have to take into account that they can do the netting if needed. They can do the PoBo CoBo. They can keep track of the accounts, which you can always access what are the positions. Mm-hmm. But the accounting behind it will mostly need to be done by yourself.
It's okay. Plus, you might lose certain benefits of the PoBo CoBo structure in the first place because that is having it in-house and not leveraging any bank, so minimizing the fees and so on. Yeah, but that's a solution. Okay. Well, I was going to ask what's the role of external banks when it comes to PoBo CoBo, but I guess one of them could be, we do the PoBo CoBo for you. What else? Because you have your in-house bank, you have your current accounts where most of the magic happens, but then you still need to, send a payment from a real bank account, right? Any other implications for external banks?
No, I think that's the main point where you mentioned whatever you do, you'll always need a bank or an external bank because you're going to execute your payments and the bank is a part of executing payments, basically.
No, okay.
So there's no way around that. You'll always have to do it.
Yeah, and I guess you have the FX rates or like the exchange rate when you need to convert currencies in case you have a bank account on behalf of an entity, but you don't have the denominated currency or certain currency that you need to potentially do a spot. Super clear. I'm a bit curious. We try with Sam to get more and more fintechs and emerging technologies and innovations talked on the podcast. Is there any new digital solution or emerging technologies that can further develop PoBo, or are we at the the state of the art in terms of PoBo already? What's your view on that?
No, I think there's still, a lot of room for fintechs to provide and to develop solutions for all type of different corporates. It's a bit like in the TMS world as well. Different vendors, different, advantages and disadvantages, and also different sizes. Not every company fits with a certain TMS, and it would be the same with the fintechs. They most likely, not most likely, but actually most of the time, a lot of these fintechs, they're really focusing on a specific market, a niche market, for example, like looking at trade finance, looking at FX trading and that kind of stuff. So I think there is still some room there to facilitate the process and to make it more standardized. If you look at a big TMS system, the whole setup takes a bit of time, and it needs to be well incorporated with your banks, with your ERP systems, with your payment hubs. But on the fintech side, there, I think, especially for not the huge multinationals, but for the companies right below that, there could be indeed a room for fintechs that are providing a more plug and play solution for corporates that are not looking at a full developed in-house bank yet.
Okay, so somehow a third party that will arrive and just set it all up for you and takes on the whole implementation if there is any, and plug and play, as you say, rather than having a whole team of consultants or even some sources within your company that needs to set up the whole thing, program the proper interfaces, and make sure everything is working. Or the other possibility is the bank that does it on your behalf, but you want potentially to have something in-house yourself.
You have to look at what is the advantage for your corporates, and what can fintechs in the market, what can they offer you as a corporate? And most of the times, the fintech, they could have, let's say, it's a more structured and standardized procedure, so probably less room for customization, but that could also be a benefit. Not everybody needs a super complex setup to perform PoBo CoBo in their corporate.
Okay. And I guess it's a little bit less linked to PoBo per se, but you also have this real-time payments that now it's a thing, right? Those payment tracking solution, I think Swift is working on the GPI. Well, actually, it's live and working already, but not all the banks are connected to this specific solution. But I guess anything that enables faster payments, faster reporting, payment tracking, and so on is also something that's indirectly help developing PoBo, or at least enhance it, right?
Yeah, I think if you look at the key drivers, indeed, what helped developing the PoBo CoBo marketplace, let's say, it's first of all the globalization. So there's a lot more, especially corporates are getting a lot more suppliers and customers in a wide variety of locations. So probably you need, in all those locations, you need legal entity, but you don't want a bank account for every currency in all those locations. So I think globalization is a key driver. Secondly, it's the importance of liquidity. So especially in, let's say, the current markets, people and companies are really starting to understand how liquidity works and why it is so important. And here it goes hand in hand with the fact that also Treasury is being more and more acknowledged as a really important function within a company. Previously, Treasury, we were put a bit, let's say, in just general in the finance team behind the accounting team, and nobody actually knew, hey, the title is treasurer. What is he doing actually? Yeah. But now it's becoming more and more important, and it's getting its more individual position or place next to the finance department. So everybody, understands the importance now of cash and liquidity. And I think that's helping, a lot as well, because liquidity and cash is being managed a lot more closely. So people are also looking at those opportunities to optimize that and to get cost savings. And that's where then PoBo CoBo comes in, because it makes it a lot easier. You can get savings like less bank accounts, cost reduction, improved cash visibility, better risk management, centralization of control, all that kind of stuff. So it's, that's one of the key drivers, in my opinion, as well, why now PoBo CoBo is becoming more and more, let's say, standardized in the markets.
That's super funny that you mentioned this, but that couldn't be more true. We had recently an episode with the thought leadership of TIS, where we were discussing the strategic role of the corporate treasury function and the corporate treasurer as a role. And it's super interesting to see that, so first of all, cash is king, and actually who is managing the cash? Normally in the most efficient way, well, it's in the corporate treasury department. We had this talk about the data around cash flow forecasting, especially in a period like 2023 or in the COVID phase, right? You want to know where your cash is, when it will come in, when it will go out. And with the evolution of technology, you want to have access to this data because it allows you better decision making. And with the very recent of the Silicon Valley Bank, for instance, we have again this whole risk management and financial risk management function that is becoming more and more strategic, having a proper look at counterparty risk management, wallet sharing. So it's amazing. Well, I have to say, Treasury is trendy, right? Lucky us, because we have a Corporate Treasury 101 podcast, but couldn't agree more.